Welcome to Talk Tickers. Today, we're breaking down Hess Midstream's fourth quarter 2025 earnings call. Now, this one's interesting because management came out swinging with this great story about a big pivot to free cash flow. But the market? Yeah, it wasn't buying it. And the reaction tells you everything you need to know.
The stock actually opened up, but by the end of the day, it was down almost 1.5%. So what happened? Why did this big, promising long-term story get completely overshadowed by what's happening right now? That's exactly what we're going to get into. Okay, so here's how we're going to break this down. We'll start with the Q4 numbers that really seem to worry people. Then we'll dig into management's big capex to cash pivot. After that, we'll look at the tough questions analysts were asking, what you should be watching for going forward, and then, of course, we'll wrap it all up with our own rating on the stock. All right, let's jump right in. What were the numbers that triggered that negative reaction in the market? Well, when you look at the headline figures, it was really a tale of two cities. Okay, so you can see the problem right here. Their earnings per share, the GAAP EPS, was basically right in line with expectations. No surprises there. But then you look at revenue, and whoa, a nearly $13 million miss. For a company where the market is already a little nervous about growth, missing your top-line number is a huge red flag. It really just soured the mood for the rest of the call. Now, if you look past the headlines, things looked pretty solid. Adjusted EBITDA, free cash flow, those numbers were good. But management knew they had a problem, and they tried to get out in front of it. They immediately pointed to severe winter weather, saying it hit their volumes hard across the board: oil, gas, and water. So, faced with these kind of mixed results, management did something smart. They didn't want to talk about the weather all day. Instead, they pivoted hard. They wanted to tell a much bigger, much more powerful story about the company's long-term future. And this quote from the CEO, Jonathan Stein, is really the heart of their new story. He's saying, look, we're done building. That huge, expensive, multi-year project to build out all our infrastructure, it's finished. And you have to understand, this is way more than just a little project update. This is a fundamental, ground-up change in how this company is going to operate and make money from here on out. And this chart, wow, it just lays it all out perfectly. Capex, right? The cash they pour into new projects, it's about to fall off a cliff. We're talking a 40% drop in 2026, and then it gets cut in half again after that. This is not some minor tweak, folks. This is a complete transformation of their spending. So the big question is, where does all that cash go now that they're not spending it? Well, it goes right into generating free cash. This huge cut in spending is expected to boost their adjusted free cash flow by 12% next year. They're guiding to a range of $850 to $900 million. That's a ton of cash. So the story they're trying to tell is super clear. It's a total shift. They're moving away from being a growth company that spends a ton of money to becoming a value company that's just a cash-generating machine. Simple as that. Less cash goes into the ground, and a whole lot more becomes available for shareholders and for paying down debt. It's a classic pivot. Okay, so that's the story management wanted to tell. A beautiful, long-term vision. But how did it hold up under pressure? Let's get into the Q&A and see what the analysts thought about it. You could tell the analysts were really focused on a few key things. They wanted to know, okay, you've got all this new cash coming in. What's the priority? Debt? Buybacks? They also pushed back on the weather excuse, basically asking how much protection their contracts really offer. And the other big one was, great, the buildout is done. So where does new growth come from? Management's answer to all those worries about volumes and weather really came down to one thing: their MVCs, or minimum volume commitments. Now, the easiest way to think about these is like a take-or-pay deal. It means their customers have to pay for a certain amount of space on the pipeline, whether they use it or not. It creates a really solid floor for their revenue. And get this, they said 95% of their 2026 revenue is covered by these contracts. That's a huge safety net. All right, so let's zoom out for a second. It's important to understand the bigger picture here, because this quarter's report didn't just happen out of the blue. Let's look at the context and what you should be watching for next. The market has been skeptical about this stock for a while now. It's not a new thing. Just look at the one-year return compared to its peers. It's been left in the dust. And that underperformance is exactly why investors were so jumpy about that revenue miss. Even with this great cash flow story coming, the trust just wasn't there. And if you look at the timeline leading up to this call, it gets even more interesting. You had big ownership changes, sure. But the real kicker was a downgrade from Raymond James just a few weeks before earnings. And what was their reasoning? They saw a weak growth outlook. That call was spot on. It pretty much telegraphed exactly how the market was going to react to a top-line miss. So what's next? What's going to move this stock? We think it comes down to three things. First, we need to see those volumes bounce back in the next couple of quarters, proof that the weather issue was just a one-off. Second, what do they do with all that new free cash flow? We need to see them actually start buying back stock or paying down debt. And third, keep an eye on the analysts. If management can deliver on this cash flow promise, you might see those ratings start to turn around.
All right, so all of that brings us to the bottom line.
So after you weigh everything, management's big, exciting pivot, versus the market's very real, very immediate worries, where do we land on Hess Midstream? Our call on the stock is this. We're starting it out with a market perform rating. And here's our thinking. That free cash flow story is fantastic. It really is. But the market is in prove-it mode right now. We think the next quarter's results, Q1, are probably still going to be messy because of the weather, and that's going to keep a lid on the stock price. So for now, we see the stock just kind of treading water, stuck in a range, until we get a really clean report in Q2 that shows the volumes are back and they're putting that cash to good use.
And a quick reminder, as always, this is not financial advice.